Elon Musk is the CEO of Tesla, a company famous for electric cars and bold innovation. But Musk is much more than just the head of a car company. He's become a symbol of technological ambition and disruption, known for shaking up entire industries with his bold ideas and relentless drive. He's not just a manager, he's a visionary, pushing ideas like self-driving cars, sustainable energy, and even reimagining how we travel and live. Musk's influence stretches far beyond Tesla, inspiring a new generation of entrepreneurs and engineers to dream bigger. He's also the driving force behind SpaceX, a company aiming to make space travel routine and to one day establish a human presence on Mars. Musk's ambitions are literally out of this world, and his projects often capture the public's imagination. Under Musk's leadership, Tesla has transformed from a risky startup into one of the world's most valuable car companies, revolutionizing the auto industry and making electric vehicles mainstream. But unlike most CEOs, Musk's pay isn't a simple salary or annual bonus. Instead, it's structured in a way that's as unconventional as he is. His compensation is tied directly to Tesla's performance. If the company grows and hits certain milestones, Musk receives a massive reward in the form of company shares. The better Tesla does, the more he stands to gain. The scale of this pay package is staggering, tens of billions of dollars, not just millions. It's one of the largest compensation deals ever offered to a corporate leader. This pay plan, created in 2018, promised Musk a huge number of shares if he hit a series of ambitious targets for Tesla's growth, market value, and profitability. Musk succeeded in meeting those goals, but some shareholders felt the deal was too generous and challenged it in court, arguing it gave him too much power and wealth. Now, a judge must decide if Musk's pay is fair or excessive, a decision that could reshape Tesla's finances and set a precedent for executive compensation for years to come. The core question remains: can one leader truly be worth tens of billions to a single company? Or does such a deal risk putting too much control in one person's hands? The outcome will impact Tesla, its investors, and could influence how companies everywhere think about rewarding their top executives in the future. In 2018, Tesla's board faced a unique challenge: how to keep Elon Musk, their visionary but unpredictable CEO, fully engaged and committed to the company's future. Instead of a traditional salary, they crafted a radical pay plan, one that offered Musk no guaranteed income at all. Instead, he would only be rewarded if he achieved a series of almost impossible goals, designed to push Tesla to new heights. The plan laid out 12 extremely ambitious targets, each tied to Tesla's market value and financial performance. These weren't just ordinary benchmarks. They required Tesla to grow at a pace rarely seen in corporate history, demanding relentless innovation and execution. For every milestone Musk reached, he earned the right to buy Tesla shares at a steeply discounted price. If he managed to hit all 12 targets, the total potential payout was a staggering $56 billion, making it the largest pay package ever proposed for a CEO. Against all odds, Musk delivered. He met every single target, driving Tesla's value to unprecedented levels and transforming the company into a global powerhouse in electric vehicles and clean energy. Shareholders who held onto their stock saw their investments multiply, reaping enormous financial rewards. But the plan also sparked controversy, and not everyone was celebrating. Richard Tornetta, a small but vocal shareholder, filed a lawsuit. He argued that the board was too close to Musk, lacked true independence, and had approved a deal that was unfair to ordinary investors. Tornetta claimed the board gave Musk excessive power and failed to negotiate a compensation plan that truly protected the interests of all shareholders. The lawsuit accused Tesla's board of neglecting their duty to act in the best interests of the company and its investors, raising questions about oversight and accountability at the highest levels. This legal battle has become a landmark test of corporate governance, challenging how much authority a CEO should wield and how boards should balance vision with responsibility. At its core, the case is about more than just money. It's a debate over fairness, transparency, and the future of executive compensation in America's biggest companies. The outcome could set a powerful precedent, influencing how companies across the world reward their top leaders and how boards are expected to act on behalf of shareholders. Now, as the courts weigh the evidence, the world is watching to see whether Tesla's bold experiment will be remembered as a stroke of genius or a reckless gamble with lasting consequences. The lawsuit landed in Delaware's Court of Chancery, a key venue for business law. Shareholder lawyers argued Musk controlled the board, and the pay plan was unfairly approved. Tesla's lawyers countered that shareholders voted for the plan, and Musk delivered huge value. In January 2024, the judge ruled against Musk, saying the board wasn't independent and voided the $56 billion package. This was a major blow to Tesla and a win for critics of excessive CEO pay. Tesla and Musk appealed to the Delaware Supreme Court, where the final decision is still pending. If Tesla wins, Musk keeps his shares. If not, Tesla faces a massive financial challenge. The ruling will set a powerful precedent for CEO pay and board accountability. Investors and corporate leaders everywhere are watching closely. The stakes for Tesla's future couldn't be higher. If Tesla loses its appeal in court, the company will be required to compensate Elon Musk for his work as CEO since 2018, a decision that could have massive financial consequences for the company and its shareholders. To prepare for this possibility, Tesla's board has put together a backup pay plan for Musk, valued at up to $26 billion. While this is still a staggering sum, it's actually less than the original compensation package that was under dispute. Importantly, this isn't a straightforward cash payout. Instead, Tesla would issue new shares to Musk, which would significantly increase the number of shares in circulation and create a huge accounting expense for the company. The company would need to record this cost over a 2-year period, which translates to about $3.25 billion in expenses every quarter, an amount that would dwarf many of Tesla's other financial obligations. This accounting move would slash Tesla's reported profits, making its earnings appear much weaker than the company's actual business performance. Even if Tesla's core operations remain strong, the reported numbers could tell a very different story. Investors and analysts pay close attention to these headline numbers. A sudden dramatic hit to profits could easily shake their confidence in Tesla's future, leading to increased volatility in the stock price. Even though this is technically a non-cash expense, it would dominate Tesla's financial reports for several quarters, overshadowing other achievements and milestones. For a company built on high expectations and ambitious growth, reporting losses for multiple quarters in a row could be especially damaging to its reputation and investor sentiment. Tesla's finance team now faces the daunting challenge of managing this impact, balancing the need to reassure investors while dealing with the reality of these massive expenses. The outcome of this legal battle could affect not just Tesla's stock price, but also its ability to raise capital and invest in future projects like new factories, vehicle models, and advanced technologies. The financial ripple effects of this $26 billion problem would be felt for years to come, shaping Tesla's strategy and its place in the global automotive industry. To grasp the scale, compare the $26 billion charge to Tesla's profits since 2019. This single expense is more than half of all the profit Tesla has ever made. For nearly 2 years, the pay charge would be bigger than Tesla's entire quarterly profit. In most quarters, Tesla's net income was far less than $3.25 billion. The result, Tesla could report negative earnings per share for up to 7 straight quarters. That's rare for a company in the S&P 500 and could trigger forced selling by some big investors. This comes as Tesla faces slowing sales, rising competition, and expensive new projects. Government subsidies are shrinking, and new ventures like robots and self-driving tech aren't yet profitable. Adding a $26 billion expense would put even more pressure on Tesla's finances. The company's growth story could be overshadowed by accounting losses. It's a critical moment for Tesla's reputation and investor trust. Musk's pay isn't just huge, it's unlike anything in corporate history. Most CEOs get millions, maybe hundreds of millions, but Musk's deals are in the tens of billions. Traditional CEO pay includes salary, bonuses, and stock awards, all carefully benchmarked. Musk's 2018 plan was all or nothing, no salary, just a giant reward for hitting moonshot goals. This high-risk, high-reward approach is rare and controversial. Critics say it disconnects pay from reasonable standards and creates massive risk for shareholders. The $26 billion accounting charge is unprecedented. No other company has faced a single executive expense this large. It's why experts are watching Tesla as a test case for executive pay limits. The situation raises big questions about how boards should balance risk, reward, and fairness. Should one visionary leader get a founder's reward, or should pay be kept in check? Tesla's approach could change how companies think about CEO compensation. For shareholders, Musk's pay plan is a double-edged sword. Early investors saw their shares skyrocket as Tesla grew, but new share awards dilute everyone's ownership. Imagine your slice of pizza shrinking as more slices are added. That's dilution. The value and voting power of each share drops when new shares go to Musk. Critics call this a massive transfer of wealth from shareholders to the CEO. The legal fight centers on whether the board protected shareholders or gave away too much. And it's not over. Tesla's board approved another huge pay plan in 2024, with even bigger potential rewards. Each new milestone means more dilution and more big expenses. For shareholders, the risk of dilution and profit hits is now a recurring issue. The debate is about balancing reward for success with protecting everyone's stake. How Tesla handles this will shape its future and its investors' fortunes. Tesla's board argues Musk is irreplaceable and needs extraordinary incentives to stay focused on Tesla. They say his pay is tied to massive value creation. If he wins, so do shareholders. Critics counter that the board isn't independent and is failing its duty to protect shareholders. They warn that such huge pay sets a dangerous precedent and could destabilize the company. The debate is about whether Tesla's future should hinge on one person's vision or on sound corporate governance. Musk's pay is a high-stakes bet on one leader's ability to deliver extraordinary results. If the court rules against Tesla, the company faces years of reported losses and shaken investor confidence. The board believes the risk is worth it to keep Musk at the helm. Critics see it as a failure of oversight and a threat to shareholder value. The outcome will define Tesla's financial story for years and set the tone for executive pay everywhere. For investors, the question is simple. Is the gamble on Musk worth the cost? The answer will shape Tesla's future, and maybe the future of corporate leadership itself.